In this video course, I'm gonna take you from an absolute beginner to a profitable day trader step by step. If you want to start making at least $1,000 every single day while only dedicating 30 to 60 minutes a day from Monday to Friday, then this video is for you. Because by the end of this video, you'll know everything you need to become a profitable day trader, even if you're starting from scratch. This complete course is packed with more value than the paid courses others sell you for hundreds or even thousands of dollars. And yes, I'm gonna give it to you for free. I'll take you from knowing nothing about day trading to understanding what day trading is, how to read candlesticks, what to trade and when to trade, what actually moves the market, my secret day trading strategy that I have never shared before, proper risk management, and much, much more. In short, I'll turn you into a profitable day trader. And now you may wonder, why am I giving all of this for free? Well, let's say like this, day trading changed my life, and now I wanted to change yours. I've been day trading for 4 years now. At first, I didn't get the right guidance. That's why I was losing for 2 years. But obviously, I didn't quit there. Then I finally got the right guidance. Nowadays, I've been profitable for over 2 years, making money consistently in these markets. Nowadays, I average around $1,000 or $3,000 a day and only dedicating 30 to 60 minutes a day. Day trading has given me time, location, and financial freedom. And I want you to achieve the same. And listen, I'm not any special. I started as an undisciplined fast food worker who was making $9 an hour. And guess what? I was also depressed. I couldn't have even imagined that this would be possible, but it is. So grab a pen and a piece of paper, put this on full screen, and let's begin. So what is day trading? Day trading is short-term investing where we can make a lot of money in that same exact day. Us day traders basically bet that the price is either gonna go up or down. See, because we can also make money from the price going down as well. Unlike in actual investing, if I buy like 5 shares of some stock, if the stock goes up, that's when I make money. But if the stock goes down, I lose money obviously. Now in day trading, if I press buy button and the price goes up, I make money. Or if I press sell and the price of the stock or whatever I trade goes down, that's when I make money. Now, the thing that I love about trading is that we don't have to wait for 40 years to make money. We can make money in that same exact day. Unlike investing, we have to wait for 50 years to make money. And if I'm being completely honest, it doesn't even take a day for me to make money. Like I told you, 30 to 60 minutes a day is all I need to make a lot of money. Now, of course, that kind of mindset can take you in a wrong path. That's why we have to use proven strategies that actually work, that have statistical and predictable outcomes, and also that work long term. Key benefits of day trading: very low time commitment. You can just trade 30 to 60 minutes a day to make a lot of money. That's what I do. No overnight risk. Unlike swing trading or investing, we actually close our profits within the same day. Very high earning potential. With the right strategy, of course, day trading can generate you a lot of money consistently. Now, before we go more in depth, here are some beginner questions that a lot of people have. How much money do I need to start day trading? So a lot of people think that they need a lot of money to start day trading, but in reality, you don't need a whole lot. You can just start with $50, $100, or $500. But remember that you should start small as a beginner because you need more practice, etc. How long do I need to trade each day? So that's a good question. A lot of people think that, I trade 5 hours a day, which I used to when I was a beginner. But then I realized that that isn't necessary. I was actually losing a lot of money back then. But nowadays, like I told you, 30 to 60 minutes a day, that's all I need to make a lot of money. And there's actually a reason why I trade 30 to 60 minutes a day. It's not because I'm lazy. It's because the first 1 hour into the session has the most volume, aka the most opportunities. But obviously, you may not understand what I'm talking about. Don't worry, I'm gonna teach you everything in this video. How long does it take to become a profitable day trader? Well, of course, that varies on the person, how disciplined they are, and how committed they are to learn. I've had people started from complete bottom to becoming a profitable day trader within just a month. Some people become profitable within 3 months, some people take 6 months, and some people even 12 months. It all depends how serious you are. But of course, the most important thing is getting the right guidance because there's a lot of fluff in the space. Some people teaching BS. Personally, like I told you, I didn't get the right guidance. That's why I was losing for 2 years. But as soon as I got the right guidance, I became profitable. That's the thing. Guidance is everything. And that's why I'm recording this video right now, because I want you to get the right guidance. What markets should I trade? Well, there's a lot of markets to trade. Actually, as a day trader, you can trade all the markets. You can trade crypto, you can trade Forex, commodities, stocks, stock indices, futures, all of it. Personally, I tend to focus on stock indices. I've been trading Forex a lot in my history. The best part about the strategy that I'm about to teach you in this video is that it works in every single market and pair, because these markets follow the same universal rules. Now it is time for me to start teaching you how to day trade step by step. Okay, it is time to finally move into the good stuff of this video. Essentially, this is tradingview.com, right? This is the hotspot for everything, right? For us traders, this is where you find the pairs. This is where you find the markets. You know, we can literally find everything from crypto to gold to Forex, everything, okay, right? Now, and the charts, obviously, you can see the charts, you can see the movement, and this is where we essentially will look at the charts and do our analysis and boom, make some money. So this is essentially what the page is gonna look like, right? When you first open it, what you're gonna do is, create an account, right? And you can get it completely for free. You don't need to pay for anything. When you create your accounts, this is exactly what you're gonna see. What you're gonna do, first of all, first and foremost, make sure that these are Japanese candles. How can you know? You're gonna go in right here. You're gonna see this button, or you can see this symbol in here that shows 2 candles. You're gonna press this, make sure it's this one. Candles. These are Japanese candles. I'm gonna explain you actually very soon about those Japanese candles, how they work, etc. But first, make sure you have these. This is exactly what we're gonna choose. I believe when you open the TradingView first time, there's gonna be some indicators right here. We don't want to use those. Indicators are essentially, they're like add-ons to the charts that can show you like the volume and some price shit. We don't need those. Those actually lag. They're not as real time as these Japanese candlesticks, so we're not going to use those. We actually can see everything with these candles. We can see the volume, we can see everything with these candles, so we don't need the indicators. This right here is the pair that you're currently looking at. I'm currently looking at the US 500. This is stock in this is what I trade. Okay, I like to trade this, or if you trade futures version, it's the E-mini future. It's the same pair, essentially. It's just a futures version. Essentially, you can choose whatever pair you want to choose. My recommendation is that you choose a pair and you stick with it, okay? You choose a pair and you don't change it much. Do not choose like 10 different pairs because it's going to mess you up. You can choose, most people like Forex. I like Forex as well. Crypto, it's all right. I have traded crypto before when I started, but I've traded Forex. I've also traded commodities like gold. You can trade stocks, whatever, but I personally trade NAS 100 and US 500. You can choose whatever pair you want to choose. The strategy that I'm about to teach you in this video works in every single pair, okay? Every single market, every single pair. The rules are universal in these markets, okay? They have the universal rules and the strategy applies, right? Essentially, right here, we can literally see some sort of like time shit. This is time frames. This is 1 minute time frame, 5 minute, 15, etc., 30. If I'm currently at the 4 hour time frame and we look at these candles, every 4 hour a new candle will appear here and the previous one will close and turn history. All of this is history, right? And this one is the current moving one. As you can see, it already has been moving like almost 4 hours because it's 11 minutes left. After 11 minutes, the 4 hour time frame, the 4 hour has passed, and this will stop moving and this will turn into history and a new candle will appear, right? Very simple, effective, very standard. Okay, these time frames, you get the point. Daily time frame, every single day a new candle will appear and a previous one will close and it will turn to history, and we can use these previous candles in the strategy to make a lot of money. I'm going to teach you later how to do that, but yeah, weekly time frame, every week a new candle will appear. Currently we're currently on Monday. There's like 4 days and 5 hours left till this will close and a new candle will appear after that, right? You get the point. 1 minute, every single minute a candle opens and a previous one will close. Very simple, effective, standard. Replay mode is very good. Okay, later, once you start to, get the strategy in this video, you can backtest the strategy with this replay mode tool. Okay, you need a subscription for this one, but you don't need it right now. Obviously, there's some other platforms for backtesting, but I like to use this one for backtesting my strategy. I've used it. I like it a lot, and simple, effective, and it works nicely because we can literally just go in here and we can see that literally this is history. It's gonna replay the candles. Obviously it's not as real time, obviously it's not as smooth as the actual live markets, but gets the job done. You can practice your strategy later. On here on the left we can see all these tools, but yeah man, you get the point. Mini tutorial of this trading view before we actually move forward. You know, I think it's very important to understand the basics, how this application works, before we actually get into the strategy. And now it is time to move on to the actual meat of this video. Pause. What I mean by that is the candlesticks. Okay, well, let's move to the candlesticks. Okay, so right here, as you can see, this is quite frankly our candlesticks. Okay, there's two candlesticks essentially. There's the bullish candlestick, which is the green one, and you know, it moves up, right? And then there's the bearish candlesticks, move down, right? This is the red one. The middle part is something called a body of the candle, right? Body, it is where the candle is currently, you know, and these smaller ones are wicks. This tells us where the candle has been. And bullish candlesticks, they always open from the bottom and they will close at the top, right? And this is where it was. This is the highest point where this bullish candle was, and this is the lowest point it was, because this is the wick, low wick, and this is the high wick, right? This is how it works, okay? This is how the candles open and close. This is where it was, this is where it was, right? You don't know is it a bullish candlestick or a bearish candlestick until it actually closes, because it can be moving here and it can actually close here, which makes it a bearish candle, right? A red candle. But once it closes, that's when it confirms that it's a bullish candlestick, right? Look at this. This is the red candle. Always opens at the top and closes at the bottom, right? Because, you know, it has to close below where it actually opened, right? It opened here, has to close below, right? That's how it's a bearish candlestick. Vice versa in here, right? But it opened at the top, closed at the bottom. This is the lowest point it was, okay? This wick tells us that it was moving here, okay? It was moving here, but then it went a little bit up and wanted to close here, right? And this is the same point, okay? It opened here, but it was moving here at some point in here, but then it went down and closed here. But let me show you in the chart so you can understand better. This right here is a bullish candle, right? This is a 1 minute time frame. Right here, it opened and closed here. Why? Because bullish candles, they open at the bottom and they close at the top. And immediately, let me go into the replay mode so you understand. Immediately after this candle, bullish candle closed, a new candle appears, starts to move right here on the body, right? It was moving here. It was also moving here, but it wanted to close here, okay? And this confirms it. This is where the candle is currently. This right here. This is where it closed. This is the body. These are the wicks. History. But all of this makes the candle, right? These wicks and the body. But this is where the candle is right now, okay? And let's move forward. This is the bottom of the red wick. That means it has to open. The next candle has to open right here. This is the bearish candle. Opens at the top, closes at the bottom, right? It was moving here. Okay, imagine that. It was moving here at some point. Probably opened here and started to move here. People thinking that, okay, it's going to be a bullish candle. But in reality, we don't know that until the candle closes, right? Look at this. This is also a bearish candlestick. Very small in body-wise. It was moving a lot, meaning there was a lot of volume. Volume essentially is the movement of the market. Okay, if there's a lot of buyers and sellers currently at the market, usually in the session open, I will teach you more in this video as well, what is session open, etc. But that means there's a lot of buyers and sellers in the market, moves the candle a lot, okay? It was moving a lot. It was moving here, it was moving here, decides to close here. And look at this, opened here, closed here. Even though the body is small, this is still a pretty big candle. Very simple. Hope you now understand the standard way how these candles work. It's very simple, very minimal. You don't need to overcomplicate it. It's not that serious. Personally, when I trade, I'm not here like, oh, so it opened, it closed here and this opened here and it closed here, so it has to be a bullish candle then. No, I just use my fucking logic. I see a bullish candle, I see a red candle, bang, okay? Do not overcomplicate it. What actually matters is the strategy that I will teach you very soon. Now, I will teach you something very, 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 very important. Okay, hope you understood that. Sessions. Sessions in trading is very important because you need to be trading in the session open. I personally trade 1 hour into the session, like 30 to 60 minutes in the session. Once the session opens, I'll trade 30 to 60 minutes, right? Why? Because when the session opens, there will be most volume. Okay, by volume I mean, buyers and sellers enter the market, a lot of people trading right there, banks are open, etc. Right? The price moves, meaning there will be more volume. Obviously, when there's more volume, you will make more money. So essentially, I'm gonna start with the basic. Okay, I'm gonna teach you about Forex sessions. Then I'm going to teach you about, New York Stock Exchange, or what I personally trade. Okay, what I want you to understand is the strategy itself, the trading strategy that I will teach you in this video, works in every single pair, every single market. But you need to trade in the session, okay? The strategy itself works in sessions, okay? Doesn't matter what session, you need to trade in the session, okay? In Forex, there's mainly 3 sessions, the most popular ones, okay? You can trade Asian session, London session, and New York session. Okay, those 3, right? Sydney, just forget it. Okay, 3 sessions: Asian, aka Tokyo, then there's the London and New York. And if you trade like GBP, something GBP, you should trade on London, right? Obviously, more volume. If you trade something like USD, you should trade on New York, right? If the pair has the USD in it, right? GBP USD. If it's GBP USD, you can trade on London or New York, right? Makes sense, okay? But regardless, you need to trade in some of these sessions. London, it opens at 4 a.m. Eastern, right? New York time, okay? And New York session opens at 8 a.m. Eastern time, right? New York time. Personally, I trade at 9:30 a.m. Eastern time. That's when the New York Stock Exchange will open, right? Because I trade stock indices. But obviously, you can trade here as well, 8 a.m., even if you trade stocks, US stocks or stock indices. But I personally like to trade at 9:30 because new volume will come, okay? Obviously, New York session is a big session. But remember, keep this one thing in mind. We can literally see, look at this. Look how it gradually, the volume start to drop. Look at this. The more we get into the session, start to drop. So keep that in mind. That's exactly why I only trade 30 to 60 minutes a day in the session, right? I start to trade at 9:30 and I usually end when? Usually around 10:30. Unless there's like a setup very nearby, then fine, I'll take it. But, after this, the volume will start to drop, less chances to win, less setups. So I use my time wisely. You don't need to be in the session for 3-5 hours. Even like if you trade Tokyo session, 1 hour into the session is fine. If you trade London, 1 hour into the session is fine. But the good thing about New York session is that it opens at 8, right? But New York Stock Exchange will open at 9:30, and this is where there's a lot of volume. Okay, a lot of volume will come into the market. So you can essentially start from here and trade till 10:30. Some people like to trade the whole session, but depends on the style of trading. I personally just want the most volume and make the most out of the trade. Okay, but remember, whatever you do, remember to trade in the sessions. There's no point in trading in the middle of the night or something like that when you're trading USD pair. Like, you should not trade in here because the markets are not open. Check this out. This is like prime time example of these sessions, okay? This is New York session when it opened today, Monday, right? And we can literally see, okay, pretty good volume. The market is moving. It has some volume right here. And then New York Stock Exchange opens, brings even more volume. Like, this is what I mean. Like, this is why I trade in the New York Stock Exchange open, because look at this volume. This volume just boom, okay, bursts of volume. And this is where you make a lot of money because the price moves, banks open, everything. These freaking Wall Street guys just start to yell. I could be trading here, but I don't need to. I like to trade here. But obviously, keep this in mind. Remember, what pair are you trading? If I'm trading NAS 100, which is a US stock index, obviously I'm going to trade in New York session, New York Stock Exchange open. Obviously, use your logic. Let's say if I want to trade Forex, I want to trade GBP JPY, which is a Great British Pound against the Japanese yen. Which session should I be trading in? Obviously, London session, British Pound. There's a lot of volume. Also, you can trade in Asian session because there's the Japanese yen. You'll move there most. But obviously remember that Asian session tends to be very low in volume. So you can, trade in London session, right? So that's exactly what you're going to do. You're going to look at your current pair and think with logic. Which session should I be trading in? If it has a USD pair, if it has a USD in it, GBP USD, let's say GBP USD, Great British Pound against the US dollar, you should be trading in either London session, okay, because Great British Pound, it has a lot of volume. I've actually traded this pair a lot back in the day, made good money in this one. Or you can trade in New York session, right? Opens at 8. You can also trade in New York Stock Exchange Open because US dollar, there will be a lot of volume in there. That's why in trading, when you want to choose your session, look at the pair and use your logic, right? Do not trade when the markets are closed in that particular session, okay? That's how you make the most money because there will be the most volume. Okay, before we actually get into the strategy, I want to talk about something very important. What moves this market? Because a lot of people don't know. What actually causes these markets to move? When you look at the candlesticks, why are they moving all of a sudden? Well, it's these big banks, institutions, and hedge funds, okay? They move the market. They have a lot of capital, like billions of dollars. You may wonder like, okay, they're moving the market, but how can we make the money? Because we are retail traders. We trade with lower capital. We don't actually see the significance in the market when we buy or sell. But the thing is, when you have a great strategy, like I have, that I will teach you now very, very soon, you can actually see like footprints in these markets by these big banks, institutions, and hedge funds. We like to call these people smart money, okay? Because they're the movers of the market, right? They leave some footprints in the markets that we can literally, quite frankly, see and mark out. Once we have enough footprints, it doesn't require a lot. I'll teach you exactly how we can do that. Then we can just execute. And the beauty about that is those footprints allows us to know where will these guys go. Because essentially, we have to understand the markets are made up of liquidity. These people want to take out liquidity because liquidity is like liquid cash for them. Okay, they need to take liquidity to fill their massive orders, right? Because they have a ton of orders. Remember, they move billions of dollars. They need liquidity to fill their large positions. This is gonna sound harsh, but there's a lot of retail traders that are liquidity. And these big banks, they're sweeping them out from the markets, causing these retail traders to lose a lot of fucking money. And there's a lot of them which allow these big banks fill their positions. Obviously, it's not all of that, but a big chunk of that is retail traders. We could also be in there, but when we use the right strategy that I'm going to teach you, we can actually manage to escape that rat race and be with these guys. We want to be the big ballers. We want to move like these guys. Obviously, we don't have the capital, but we can just follow their footprints. But so listen, so what these big banks, what they do is they manipulate the price, the smart money. They manipulate the price and they make these retail traders think that the price is gonna go a certain way. And once these average retail traders enter the market, they will just get liquidated by these people, okay? They'll just get vanished from the market. And then they're like, fuck man, shit, I lost money. We don't want to be those average retail traders that use like support and resistance, trend lines, patterns. Those people will get liquidated, okay? They do not have the brain. What we want to do is trade like these guys, follow their footprints, and then we could just ride the wave with these guys, okay? Even without the capital, it's crazy. Without the capital, we can trade like these guys. Follow the footprints. And now it is finally time for me to teach you my secret strategy that turned me and so many of my students profitable all over the world. Alright, so this is day 2 of me recording this video. Now, like I promised, it is time for us to move on to the strategy part of this video. And I will start with very simple. I'm going to start with the lifeblood of the market. Essentially, how do these markets move? This is very important because the way these markets move, it's repetitive, okay? It continues to move in this kind of cycle. I'm going to explain you how does it move. So these markets, they move in trends, okay? There's 3 trends how these markets can move. I'm going to show you quickly. These are the three trends that these markets have, okay? There's no other, okay? There's the uptrend, downtrend, and consolidation. What we want to see to make money is these two, uptrend and downtrend, because this is when the price is actually moving. Sideways movement is when the price moves sideways, okay? There's not much money to be made, and essentially it is caused by equal amount of buyers and sellers at the same time pushing the price up and down, which means it cannot move, right? It's gonna stay stagnant. Or it can be caused from low volume, okay? Not enough buyers or sellers in the market, right? We don't want to see this. This happens for a reason, but I'll explain you later why does it happen. But essentially, what we want to see is these two, uptrend and downtrend. Right, I'm going to start with the trend number one, which is the uptrend, okay? Uptrend moves always like this. It moves in higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, right? As you can see, it is very repetitive. It moves like a wave. And in this kind of scenario, we have to look for buys. Why? Because think about it. When the price moves up, we obviously want to follow the markets. These big banks, institutions, and hedge funds, smart money, right? They're seeking liquidity above somewhere here, and they're pushing the price to up to take it somewhere there, okay? And we can just follow this wave and make a lot of money. We don't want to go against these markets if it goes up, okay? We don't want to sell here. We want to buy here, okay? And then there's the downtrend. Downtrend moves in lower lows, lower highs, low lows, lower highs, low lows, low highs, low lows, right? Very repetitive, just like this, but in this case, it moves to the downside. And obviously, naturally, what do we want to do in here? We want to sell the markets. Very simple, very consistent movement right here, okay? And it's very easy to spot these patterns. I'm going to show you soon in the markets with the Japanese candlesticks. But now, this trend has two parts, okay? As you can see, this right here is the big move of the trend. And this is the small move. Big move, small move, big move, small move, big move. The big move is called an impulse. The smaller move is called a retracement. Impulse, retracement, impulse, retracement, impulse. The reason why the price wants to retrace is for the price to fix itself, okay? There's also orders in here that the price need to take a little bit fake out the market. But essentially in these kind of scenarios, even if it goes a little bit down, don't worry, because if it's in a strong uptrend, it will most likely continue up and we'll just follow this trend, all right? And same thing in downtrend. Impulse, retracement, impulse, retracement, impulse, retracement, impulse, aka low lows, low highs, low lows, low highs, low lows, low highs, low lows, and obviously higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs. Right. Then I want to talk about something very, very powerful in this trend. There is a higher high and a retracement, aka impulse retracement. A high will be created right there. Okay. And when a new candle, an up candle in this case, closes above the most recent higher high, like this, it will be called a break of structure, BOS, right here, okay? When this candle closes right here above the most recent higher high, it's a BOS, break of structure, right? And, you know, you can naturally start to look for buys in here. And if you miss it, you can just wait for a retracement, because naturally the trend will want to fix itself by doing the retracement and then breaking structure. Right here, naturally, when this new higher high closes above this higher high, there will be what? Break of structure, BOS. And obviously here you could potentially buy, follow this trend and put the stop loss below this higher low, right? Same thing in here. Once this retracement happens, this high will appear, and you want to wait for the up candle close above it. That's when the BOS happens. Okay? And essentially you could just buy here, put the stop loss here, etc. And just look at this. Retracement, what happens here? There will be a high, okay? An up candle close above it. What will appear? BOS. Okay? Simple, it's repetitive, and this is how you follow the trend. Now let me show you in the downtrend real quick. When the price moves down like this, it moves in low lows, low highs, low lows, low highs, low lows, low highs, low lows. Remember, impulse, because it's a big move in the downtrend, and the retracement, smaller move. When the retracement happens here, you're going to mark this low right here. And once this down candle closes below the most recent low, it's going to be a break of structure. And potentially here you could sell then when the new candle appears. Or if you want to wait for more confirmation, wait for a new retracement, aka lower high. And then this lower low will appear. And then you just want to wait for a down candle close below it. And then it's going to be a BOS, right? Same thing in here. This is it's not a low low yet until it will create this retracement. Then when you wait for the down candle to close below it, remember it has to close, not just move there, has to close below this low low, then it's a BOS, right? And here you could sell potentially if you want to. Now these trends, they happen everywhere, okay? They happen in every single time frame. They happen in every single pair, every single market. This is what I mean. This strategy works, but obviously this is not all of it. You need you need more to know. Oh yeah, and of course then there's the consolidation, but forget about this. This is when the price just moves like this. Like I told you, what causes this? It's those equal amount of buyers and sellers in the market. Pushes the price in both ways. The price cannot move, right? Or there's no volume, simply no volume. The markets are closed. The price is not moving anywhere. Just if you see this, you can just call it a day if it happens too much. For example, for instance here, what is this? This is a perfect example of consolidation. As you can see, there's no clear direction of the market. The price ain't moving anywhere. As you can see here clearly there's not much volume because of, look at the size of these candles. Okay, sometimes there is volume, but it still moves like this because, like I told you, equal amount of buyers and sellers, right? Pushes the price in both ways. The price cannot move. Okay, so this is what you don't want to see. What you want to see is this kind of price. And look at this. Then we start to create our higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. Look at this. A little bit consolidation happens, right? But then we start to create again higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs. You get the point. This is how you spot these trends. They happen everywhere. And look at this. Look at this. What is this beautiful, beautiful uptrend right here? This is just a perfect example when you should look for buys. What is this? Look at this. This, we start to create what? We start to create our higher highs, higher lows. Let's zoom a little bit so you can see. We start to create, let me show you again. We start to create our higher highs, higher lows. As you can see, we continue higher highs. Okay, a little bit consolidation happens here and there. As you can see, the markets are not even open here. Higher highs, higher lows, higher highs, and again, consolidation, right? Happens. We don't want to trade here. We want to trade in this market. We don't want to trade here. We want to trade right here. But this was Monday. Monday usually tends to have lower volume. Right now it's Tuesday. As you can see, as soon as Tuesday hits, we start to finally move in nicely. Okay, even if it goes down, we have to wait. Does it now start to trend down? But this is real time. I will trade later in the day. As you can see, it's currently 4:30 a.m. Eastern time, and the session will open at 9:30 a.m. Eastern time, right? So obviously, I will not trade right now. When the session opens, then I will trade. And obviously, this is the key. When you actually get into the session, you have to see what is the current market trend in that particular time. When the session opens, if it respects the downtrend, you need to look for sells, okay? And if it respects the uptrend, you need to look for buys. But yeah, let me give you an example of a very strong downtrend. Okay, this has a lot of volume. We can literally see by the size of these candles, these are huge, which means there's a lot of movement in the market. And this is, quite frankly, I mean, this is 10 a.m., 9 a.m. It makes sense that there's a lot of volume because session is open right here. It was open, but still has amazing amounts of volume. But essentially, it moves in lower lows, lower highs, lower lows, lower highs. Look at these huge dumps, lower lows, lower highs, low lows, low highs, and lower lows, right? Look at this. If we just show you in the chart, if we show in the draw chart, look at this. I know, looks kind of weird, but low lows, low highs, low lows, low highs, low lows, low highs, low lows, low highs, low lows. We have to look for sales in here. So you have to look for sales when the price is trending down. As you can see, we're currently in an uptrend. We create our higher highs, higher lows, higher highs, and we see the respect. That's the key. We need to see the respect of the trend, and it's currently going up. So I want to look for buys because most likely the trend will continue up. As you can see, remember what I talked about earlier. This is essentially the higher high, higher low. This is also the impulse and retracement. And when the retracement happens, here will be the high, right? Higher high. What I want to see is an up candle closing above this high. And let's see, does it happen? Okay, it did. So now I would then buy right here. I'll put the stop loss below this down candle, below this higher low, right? Put it right there. And I would target this high right there because there would be resting liquidity Okay, almost 1 to 2 return ratio. Let's see what happens. Okay, there we go. And as you can see, it didn't react much of the liquidity, actually respects the trend again. Actually, here's a perfect example of a re-entry. I would then mark this high. As you can see, this is a higher high, higher low. Then we actually close above it. So that means this is, again, the break of structure. Just like previously, like I told you, this is break of structure. I'll put this long position right here, put the stop loss below this higher low. And right now, I don't see much, but I would get like a, let's say 1 to 2 reshort ratio. Okay, this allows us to multiply the money and see what happens. There we go. Look at this. Look at this. This is just amazing how this works. Okay, as you can see, it taps into this and then just continues up. And here again, I could potentially look for even more opportunities because look at this. This is a high. And we'll see the constant respect of this trend. That means this trend is still valid. As you can see, this is the high. And then this up candle closes above it. Again, break of structure. And I'll put stop loss right there. And I would want to get like a 1 to 2 return ratio, perhaps. Let's see. Okay. A little bit consolidation. There we go. As you can see, got some consolidation attacks. This is, makes sense. Not much volume. This kind of at a weird time. This is like in the 3 a.m. But still managed to go there because this is the current trend. And the price will continue until it's unvalid, until it actually stops moving in the uptrend. Okay, and you have to look for buys when the price is trending up. Very simple. But as you see, you may wonder like, why does it all of a sudden switch its direction and start to move in different ways? Well, actually, there's something that we need to know. Now, like I told you, trends, they move repetitive in one direction. But however, what you need to understand that these trends, they will switch the price direction if there is a good enough volume change. And those volume changes can happen from liquidity sweeps or also sometimes from news events. I will teach you about news later in the video. But liquidity sweeps, I'm going to show you what is liquidity exactly. Like I told you, I told you a little bit what is liquidity. It's these stop losses of retail traders, and there's a lot of stuff that these big banks, institutions, and hedge funds need to fill. And with liquidity, they can do that. They can fill their large positions with taking liquidity. Okay, and the way you actually spot these liquidities is very, very simple. Now, when spotting liquidity, we have to focus on highs and lows because above every high, there's resting liquidity that these big banks, institutions, and hedge funds want to take. And below lows, there's also resting liquidity that these big banks, institutions, and hedge funds want to take. Now, you may wonder, what the hell are lows and highs? Well, essentially, I'm going to quickly teach you how can you spot highs and lows in the markets. A high is being created by two candles always. Both of them are created by two candles that are together. First of all, a high is being created by an up candle that is then followed by a down candle. This is a high. This means above here will be resting liquidity. And a low is being created by a down candle that is then immediately followed by an up candle, right? And below here is resting liquidity, but here's a low. And this is a low. And below here will be resting sell side liquidity, and above here will be resting buy side liquidity that these big banks, institutions, and hedge funds want to take out. Now, how does it work with these trends? Well, essentially, let me quickly teach you. Let me turn this red so you can understand better. Let's say if we're currently in a downtrend, right? How does the downtrend move? Low lows, lower highs, low lows, lower highs, low lows. In this particular case, we want to look for sells right here, okay? But you will have to understand, why does it move down? Why is the price moving down at that point? We want to look for sells in here, but the reason is because these big banks, institutions, and hedge funds, they're pushing the price to take out liquidity below, then they can switch the price direction. Okay, so what I want to do is mark out these lows and highs and then wait for the price to get there and obviously sell in the meantime. So it moves in low lows, low highs, low lows, low highs, low lows, low highs, low lows. Once it sweeps the liquidity, the low, like this, there is a chance, actually a huge chance, that the price will then switch the price direction to the upside. But obviously we don't want to enter yet. We want to wait for the kind of reaction for us to know. So what would happen here is something called we want to see a break of structure to the upside. I like to call it a market structure shift. Okay, when an up candle closes above the most recent low high. Remember, low lows, low highs, low high. That is also called a break of structure, right? BOS. And then when the up candle closes above it, I'll actually like to go to the 1 minute time frame. So if I see the 1 minute BOS, two of them to be exact, two of them in repetitive mode, like this, two BOSs after the liquidity sweep, that's when I would start to then look for buys above from here, okay, and target some liquidity above so that the price can then later switch direction to the downside. But then I can ride the wave in the meantime to the upside, right? So here, the reason why I want to see two breakout structures to the upside after liquidity, because this allows us to sort of see the trend movement already. We can see the higher highs, higher lows, higher highs, and most likely we'll start to continue from here. Higher lows right here, higher highs, higher lows, higher highs, higher lows, higher highs, etc. Target some more liquidity, and then it can do the same exact scenario. But obviously, you cannot always, these liquidities, they do not always switch the price direction. What we want to see is this confirmation, which is two BOSs. I'm going to show you later in the chart how you can spot it, don't worry. This may feel like rocket science, but it's actually so simple. Happens every single day, and it's very simple, okay? But this is the low. Now, let me give you an example of an uptrend. Higher highs, higher lows, higher highs, higher lows, higher highs. Remember, the smart money is pushing the price to the upside because it wants to take out liquidity eventually to fill the large position. And higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. Once it takes the liquidity, we want to obviously first look for buys in here, okay? But once it takes the liquidity, we can wait a little bit, okay? We can wait for the price to break structure to the downside, right? How does that happen? A down candle close below the most recent higher low right there. This is our first break of structure. It broke below the higher low. And then we want to see the retracement, aka a lower high, and then a lower low. Then it confirms the second BOS, break of structure to the downside, after the liquidity. Okay, now this is in 1 minute time frame. This has to happen in 1 minute time frame. This is after the liquidity. Remember, after the liquidity, then if you see these two, then you can short the markets. Okay, and then I would start to look for sells in here, potentially. And remember, sometimes, like I told you, it doesn't always switch the trend after the liquidity because there could be some more liquidity above that the price want to take. And obviously, that's why we want to see the two breakout structures to the opposite direction after the liquidity to confirm that. And then I would then proceed to look for the opposite direction trend trades. Okay, but look at this. Sometimes it will take the liquidity and then it will just continue naturally, take out some more liquidity, and then it can switch the price direction. But I'm gonna give you a secret about these highs and lows. These highs and lows happen in every single time frame. The lower time frames don't have that much power and influence. What we want to focus in, if we want to seek out liquidity, is spot these highs and lows above 15-minute time frame, because higher time frames hold more power and influence. Now, when you seek it in the 15-minute and up time frames, there will be much more power and influence, aka much more liquidity resting. Okay, now let me show you the charts how we actually spot these highs. Well, look at this. Remember what I just said. For instance, this is, I like to mark these liquidity areas just to be ready when it once later get hits to see what kind of reaction will it give us. But for instance, this is an up candle that is then followed by a down candle. Here is a buy side liquidity, and potentially once this gets hit, this is a 15 time frame, it could potentially react to that. Okay, but if it doesn't, then that's cool. And also, if you want to spot those lows, for instance, this is a low right here. This is a down candle followed by an up candle. This is a down candle followed by an up candle. This is a low. And actually, look at this. This actually got reacted a little bit, but this isn't anything crazy. But this is a down candle followed by an up candle, swept the liquidity, and then we'll continue. But we kind of start to already transition to the uptrend. But still, look at this. This is a down candle followed by an up candle, swept. This is also a down candle followed by an up candle. So what are these? These are lows. And all of these lows still have the power if it's not already swept. As you can see, this already got swept, so we can remove that. But this is a low. This is a low. And as you can see, these lows happen in every single time frame. And look at this. This is also a 15-minute low. This is a down candle followed by an up candle. And you may wonder, why am I marking out below the up candle if it's a low? Well, for the simple fact that since a high and a low takes two candles to form, you're going to choose the more prominent one, the more influential one. So since it takes 2 candles, this is the low, right? It could be also this one if this down candle would be lower than this up candle, right? But it takes 2 candles, so this is the low, right? And this is not a low, by the way. This is, all of these are not lows except this one, because a low takes 2 candles to form, a high takes 2 candles to form. And as you can see, this high got tapped into. Here's resting liquidity, not crazy amounts because it's only 50-minute time frame, but it got tapped into, and you may wonder, why didn't it switch the price direction? Well, it's for the simple fact that not every time it happens, right? Especially, this is just a 15-minute time frame, but we want to see the reaction of that, okay? And let's just see, did it happen? Did the reaction happen? If we go to the 1-minute time frame, when it gets swept, I think this is the high. Let's see what happens. If it gets swept, and does it give us the 2 break of structures to the downside immediately? As you can see, it doesn't happen. By the way, those break of structures to the downside has to happen fast. So obviously it will not react and start to switch the price direction, at least yet, because it didn't give us the confirmation that will do that. What it actually did was respect the 50-minute uptrend instead. So obviously we would have to look for buys in here, because what is this? This is literally our higher highs, higher lows, higher highs, higher lows. What is this again? Impulse, retracement. This is a high. Also, yeah, a high, I know. But it has liquidity, but it's not enough for the smart money in this case, which it means the candle closes above it, which confirms that it's a 50-minute break of structure to the upside. So I would still continue to look for buys until we take some more liquidity and then switch the price direction. But that's what I mean. If you see a liquidity sweep, but it doesn't actually give us the confirmation, then you cannot enter to the opposite direction. What you have to do is, if you see the sweep of liquidity and it just continues to move in the original trend, you just follow the trend. Just follow the current trend that you're in, okay? You need to see the reaction of the switch, right? But let me give you an example of a actual sweep of liquidity that works. Because like I told you, this liquidity sweep, they do actually work, but especially in the higher time frames, they have more influence. So I just moved to the 4-hour time frame, and I see this nice low, these lows in here. As you can see, this is a low right here, but it didn't get swept right here. Let me move to the replay mode. Didn't get swept, but these got swept. This is a low. This is a down candle followed by an up candle. This is a down candle followed by an up candle. These got swept. As you can see, this is the thing what we want to see. We want to see that immediate reaction. Candle starts to reject from the liquidity area once it got swept. This is a perfect opportunity to start scouting for buys. And then I will go to the 1-minute time frame. This is actually very interesting to see. We take the liquidity, and this is actually prime time example why you need to be careful when you want to look for those BOSs, because as you can see, it actually a little bit fakes it out before. We broke structure once in the 1-minute time frame to the upside. This is a high, and this up candle closes above it. Remember, this is the high, aka the lower high, but this is also a high because it's an up candle followed by a down candle. Broke structure above it, right? And then we can quite frankly see that it doesn't break structure the second time. We actually create this high right here. We create this up candle followed by a down candle. Normally, if I would want to look for buys in here, I would want to see an up candle close above it, but this is just a wick of the candle. It doesn't close above it. Then it continues down, so I would not look for buys yet. As you can see, it goes a little bit down further, manipulates the price a little bit, consolidates as well. Then I would still look for buys if I would see the 2 break of structures, because we're talking about 4-hour time frame liquidity that we took. That's a lot of power influence. Okay, we broke structure once right here. This is an up candle followed by a down candle. Then it creates a new high, up candle followed by a down candle, but it doesn't break structure. Continues to go down, up candle followed by a down candle. Now it broke structure once. This is a literally body closing above this. And then we actually create a new high, and boom, look at this. We actually now broke structure above it. As you can see, this is very messy. It doesn't usually happen like this. Usually there's a liquidity sweep, and then there's the 2 break of structures. But look at this. This is a high, up candle followed by a down candle. We're going to put it right here. Forget about this. This is just wicking above it, but this is nice. This is when it breaks structure. Look at this. This is a body of the candle closing above it, closing above the most recent high. And this is called a break of structure, the second break of structure, because it happened already here, happened here after the liquidity sweep. And even though it didn't happen the most beautiful way, still. So look at this. I would buy right here on the money when this body of the candle closes above this high. I know this looks very messy. Usually it happens a lot smoother, but this is also, it's good to show these more complicated ones. And I'll put the stop loss below the most recent higher low, a little bit for the spreads as well. And then I would target some new highs, because highs has liquidity, remember. I want to target areas that the price could potentially switch its direction, right? And let's see what happens. Look at this, not the most cleanest price action, but it's still there, right? It takes some time. Yeah, there we go. Look at this. Very nice, almost 1 to 3 restored ratio. I could have potentially targeted even higher, but this is good enough for me. I would have taken this trade. How did I take this? I saw a 4-hour time frame, sell side liquidity getting swept. It was around here. And then we see the breakout shock, 2 breakout shocks in the 1 minute. Didn't happen that smoothly. Normally it happens immediately. But as you can see, then it continues up. Not the most beautiful way, because it doesn't move that beautifully, but if we actually scale up a little bit, then we can see the trend movements. It moves in higher highs, higher lows, higher highs, higher lows, higher highs. As you can see, and this is the official trend. And the reason why I targeted here, because there's liquidity as well, but this time it didn't want to react off of that. But yeah, you get the point. That's how you find trades with liquidity sweep plus the 2 BOSs, right? But look at this, we can literally see these sweeps of liquidity happening everywhere. As you can, this is also a low in the higher time frame, get swept, start to trend up, etc. Here's also lows, sweep of liquidity continues up, and not the beautiful price action, but still it creates liquidity, etc. And by the way, remember, I promised to tell you, but consolidation happens for a reason. It allows us to also create higher time frame liquidity, because if we see lower time frame consolidation, right, move sideways, it will create higher time frame highs and lows. So that's also nice. And remember, these liquidities can also react momentarily. As you can see, this is a 4-hour time frame high right here, gets swept right here, momentarily goes down, right, because it's liquidity. And then it happened to take out more liquidity below here, and then it continues up, okay? It can momentarily switch the price direction and then takes more liquidity and then continues up, okay? Very simple, effective. It didn't react to this liquidity. Like I told you, not all of these liquidities have enough power for it to switch the price direction. That's why we need to see the lower time frame confirmation, the trending actually, the actual trending to the downside. And then we can start to look for sells. Look at this. This is also liquidity right here. Swept and then continues up. This is a beautiful uptrend, higher highs, higher lows, higher highs. But remember, the most important thing is to understand how to spot the trend. You need to follow the trend accordingly, okay? If it moves down, you need to look for sells. If it moves up, you need to look for buys. Follow the wave. Here, for instance, I would look for sells. We move nicely in a downtrend, and I would obviously be prepared. I would mark out some liquidities, and once the liquidity gets swept, then if we see the reaction to the upside, then I will look for buys. And right here, it starts to actually trend up. We create our higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, right? And here I would look for buys because it moves nicely in a trend. And obviously, for the future, I would be prepared. I would start to mark out these highs. And once this gets hit, I could wait if it gives us reaction to the downside. If it doesn't, then I'm just still looking for buys in here, okay? As you can see, it doesn't react to that. No reaction. I would continue to look for buys. Simple, effective. Now, I have a question. Would you want to buy or sell in this kind of price action? Of course you want to buy, okay, because it's a trend. It moves in higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs. Remember, like this, very consistent. So let me quickly teach you this again. So if we're currently in a downtrend, right, we create our low lows, low highs, low lows, low highs, low lows, low highs, low lows, low highs, low lows, right? We want to constantly look for sells, okay, in this price. If the session opens and we see this kind of movement constantly, we want to look for sells by seeing these lows getting breaking below again and again and again, right? Want to look for sells in here, right? Now, when there's the liquidity sweep, let's say here is the low in the higher time frame, right? There's the down candle followed by an up candle, right? In the higher time frame, let's say above 50 minutes. If it gets swept, you're gonna wait a little bit, okay? We're gonna wait a little bit. We could, if we look for trades, you could have potentially targeted that like this, okay? This is not a great example, but you could have target like this, target the liquidity. Once it gets hit, this is your take profit. After the liquidity sweep, if it just starts to retrace, impulse, retracement, impulse, you're just gonna continue the trend to the downside. Look for sells again, okay? Because that means this didn't have any significance. You're just gonna look for sells, okay? Now, on the other hand, if it gets swept and it immediately starts to react to the opposite direction, creating our higher highs, higher lows, higher highs, higher lows, higher highs, you're gonna look for buys, okay? Because that's the trend switch, okay? Because that means the big banks, institutions, and hedge funds are happy now because they took enough liquidity to fill their large positions. It's time to switch the trend, right? At least momentarily. And then same thing, when the uptrend moves, you're going to look for buys. And when liquidity gets hit, you're going to potentially target that when you look for buys and just wait a little bit. See, does it give us the reaction? If it doesn't, you're going to continue to look for buys. If it gives the reaction, breaking structure 2 times, you're going to look for sells. Simple. And this is how you follow the trend literally. This is a higher highs, higher lows, higher highs, higher lows. As you see, for instance, you could have bought it from here. You could have bought it from here. This is a high. Up candle closes above it. You could have entered buy positions. As you see, you could have bought it from here or even here. But this is like an example, okay? 1-to-1 ratio, not the greatest. But yeah, man, that's how you follow the trend. Always follow the trend. If we see the liquidity sweep after that, then just wait a little bit. And if it gives us the confirmation, 2 broker structures to the opposite direction, you're gonna follow the trend to the opposite direction. If it just ignores the liquidity and continues to go in the original trend, you're just gonna follow the trend where it was going in the first place. Now it is time to talk about something very important. News events. If you skip this part, this is going to be very dangerous. Trading is going to be very dangerous for you because you do not understand the news events that could hit and potentially just explode the market, and you could get stopped out, liquidated out of nowhere, and you wonder like what happened. I remember way back, I didn't know about news. I was just losing a lot of money because I was in a trade and then it just exploded and liquidated out me from the markets because there was a huge bump in the market, right? It was caused from news, and news also causes volume changes that could potentially switch the whole trend direction, right? But essentially, when you open forexfactory.com, you're going to go into the calendar, you can see the news that is coming. I'm just going to keep it simple. I'm going to go into the filter and I'm going to narrow it down heavily. I'm going to only choose the pair that I personally trade. I'm going to choose the currency that is related to my pair. So if I trade US stock indices, obviously I'm going to choose USD, right? And I want to choose these 3, red folder and orange folder. And obviously this is something very important. Use this because I'm going to explain you why later. But essentially, you're going to choose your pair. You're going to choose your currency. If you trade like Forex, like GBP USD, then obviously you should choose also GBP and USD. If you trade like GBP JPY, like this, GBP JPY, then choose these 2. And but to be honest, you should always keep USD on, okay? Always keep USD on because we know how powerful USD is. Like they have a lot of news, very high impactful news. So you should always keep USD. And if you trade like these 2, you should keep this as well. But I personally use this only because I trade the US 500 or NAS 100. So it makes sense. Today, as you can see, there will be some news. 9 a.m. Eastern time. These, I don't really care about orange folders that much. Okay, orange folders, they usually do not have that great of an impact. And you don't even have to actually, like, if you open the details, let's be honest. Do I always watch these details? Hell no. I'm already like kind of used to this. I know that these won't have that great of an impact, and I usually with the orange folders, I want to, if we get too close to the news, I'll just wait a little bit and then I will just continue after that. I'll wait like 5 minutes for the news and then it hits and boom. And if it's like in 30 minutes, then I could just trade before that. I don't care. Orange folders, I don't care that much. But when we're talking about like red folder, like this is 8:30. Well, I don't personally trade in this time. I trade here, but let's say if this would happen, red folder, if it happens in the next 30 minutes, I would still look for trades. But if we get 10 minutes before the news, I'm going to wait for the news to hit. And then after that, I'm going to see what the price looks like. CPI news, very, very dangerous news. This is one of the most high impactful news data. And this will absolutely destroy the markets most of the time. Okay, most of the time. So what you want to do is not trade during this time unless you like gambling. Let me show you what happens in this time. Okay, this is Wednesday. Okay, so I'm currently at the charts right here, 8:30 a.m. each time. Right this time, the news of CPI will happen, right? News data. Okay, let's see what kind of impact will it have. This is just a perfect example. For example, let's say if I would be in a sell position, I would target something like this, which obviously I wouldn't be in this case, but this is just an example. Let's see what could happen. Look at this. This is what I mean. This news data, look at this huge candle. And news are unpredictable. Remember that. News are unpredictable. I'm going to say that, and I'm going to say that proudly. They are unpredictable. It's gambling. You should not trade right before news, okay? I'm talking like 5, 15 minutes or 10 minutes before news. The reason is because they can just completely liquidate people out of the market. And let's say if I would have a stop loss right here, with the news, with the high impactful news, it could actually stop you out from here. So you'll end up losing a lot more money. Obviously, if you get lucky, if you had a position, then okay, cool, you're lucky. But yeah, you should not trade right before news. This is the exact reason why. There's a lot of high impactful news, but I'm just saying like this. Red folders almost always have impact. Okay, some have more impact than others, but still, the general rule of thumb is that you should not trade right before the news, right before any news, even orange folder news. You should trade 5 minutes after the news, okay? Because then the price will kind of regulate and slow down, and then you can catch the trade. But right before the news, it's not smart. I'm talking like 10, 15, 5 minutes before the news, you should not trade. 30 is cool, 1 hour is cool for sure. But yeah, you have to understand that. Never ever trade on US bank holiday. It shows in gray, okay? Never trade because the banks are closed, everything's closed, the markets will not move, there's not a lot of money to be made. Even if the markets move a little bit, you should not trade, okay? Because there's not much volume and there's not much money to be made. Now I'm going to talk about the most important strategy in trading. It is your risk management strategy. If you do not have any rules with your risk, then you're just essentially gambling and you're going to lose your account. I actually have a simple rule with my risk in trading. So I will not risk more than 5% each trade. And by 5%, I mean 5% of my trading account. So let's say you have a $100 account at first. You will not risk more than $5 each trade. And for me, 5% is my max. And I will only risk 5% if the setup in trading is very, very A+, meaning it's very most likely to hit the take profit because it's very nice and price is trending nicely and everything's going nicely. Then I will risk 5%. But keep this in mind. I also risk less if the setup is not that great. For instance, if there's not great confluences nearby or the price is not that smooth currently, either I will skip the day, I will not trade, or I will risk less, let's say like 1% or 0.5% or sometimes 2%. That's how it goes. You need to optimize accordingly with the plan. And naturally, you need to be disciplined enough to follow that rule because when it comes to risk management, you just cannot be playing around. Now, this is also very important, okay? I want to talk about the risk-reward ratio in trading. This is very important. I cannot even tell you how important this is. So risk-reward ratio is essentially your profit versus your risk. As you can see right here, you can see risk-reward ratio 1. So it's 1-to-1 risk-reward ratio and it's equal, okay? The green is the size of the red. So essentially, you're going to risk the same amount you could potentially make. And the reason why I'm not the biggest fan of 1-to-1 risk-reward ratio, because you have to be almost every time correct. You have to have a huge win rate, which I actually have a very nice win rate. But still, you know, a lot of people are not comfortable with that. That is very stressful for most people to have a small risk-reward ratio. But essentially, 1-to-2 risk-reward ratio is nice. As you can see, this profit area is 2 times bigger than the risk. So you're gonna risk, let's say $100, for instance. You're gonna risk $100. If it taps into the stop loss, you're gonna lose $100. But if it taps into your take profit, you're gonna make $200. With a 1-to-3 risk-reward ratio, if you take a trade, if you lose, you're gonna lose $100. If you win, you're gonna win $300. Let's say if you risk $100, okay? Obviously later, if you risk like $500, you're gonna make 1.5k if you win it. If you lose, you're gonna lose $500. This is a key to trading success. You have to make sure that your winners will always outweigh your losses. The way you can do that is with risk-reward ratio and risking properly. So you need to risk more when you have the bigger opportunities to win. And obviously you need to risk less or skip the day when the odds are not with you. And obviously make sure that when you're right in the trade, you will make more money. Okay, that's how you beat these markets. Look at this. This is a risk-reward ratio and win rate cheat sheet. You can actually see you're going to be profitable with your risk-reward ratio and win rate combined. As you can see, the top right here is win rate and the left right here is your risk-reward ratio. With a 1-to-1, like I told you, you have to be almost every time correct. You have to have a nice win rate to make profits. So with a 1-to-1, you're going to be unprofitable with 20, 30, 40, and 50% you're just only going to be break even. With a 60% win rate, you're barely profitable with one-to-one. That's why I'm not the biggest fan of one-to-one. Many people cannot handle the heat. Okay, 1-to-2 is nice because you're going to be unprofitable only at 20 and 30, but with only 40% win rate, you can be profitable with your trading. That's why I said, make sure that your winners outweigh your losses. And that way you can be profitable with a low win rate. Now look at this, 1-to-3 reshort ratio. You're going to be profitable at 30% win rate. Look at this, 1-to-4 reshort ratio. You're going to be break even at 20% win rate. And look at this, 1-to-5 reshort ratio. You're going to be profitable with just a 20% win rate. You can still make money even if you lose 80% of your trades. That's what I mean. Reshort ratio is everything. Make sure that your winners outweigh your losses in the way that I just told you. You have to have a good reshort ratio and obviously risk accordingly with the trade. At this point, you have everything you need to start trading. How the market works, the best trading strategy, risk management. You now have a solid foundation, but this is where the real work begins. Learning is the first step. Taking action and executing consistently is what brings the results. But here's the harsh reality. Most traders still fail. Not because they lack knowledge, but because they lack guidance, accountability, and support. You might have the perfect strategy, but what happens when you have questions or you hit a losing streak? What happens when your emotions get all out of control? What if the market conditions change and you need to optimize, but you don't know what to do? This is exactly where most traders get stuck. They hesitate. They second guess their trades. They let fear and doubt take over. And before they know it, they have blown their account and they feel like giving up. Right now, you have two options. Option one, the slow way. You take everything you've learned today and you try to figure it out on your own. This is the option I chose 4 years ago, and I regret it. It took me so long to figure out everything on my own. I blew multiple trading accounts. I had self-doubt and it felt like I was going in circles because I had no one to guide me. If you choose this path, you'll succeed much slower because you have to navigate everything on your own. You won't have anyone to guide and answer your questions. You will most likely lose a lot of money, which will slow down your progress. And that's why I want to give you the second option. This is for the traders who want to hit 6 figures within the next 3 months. It's a shortcut. Allow me to introduce you to Elite Traders Lab. It's my one and only trading mentorship that turns losing traders into consistently profitable and independent traders. I know exactly how it feels to struggle in the markets. See, because I wasn't always a successful trader. I started as an undisciplined trader and a fast food worker who literally couldn't keep his trading account alive for more than 2 days. I had no discipline, no strategy, and no real understanding of the market. But obviously, I refused to accept failure. With focus and dedication, I transformed myself into a 6-figure full-time day trader with complete financial freedom. I no longer work for someone else like a slave. I trade on my own terms, and now I help others do the same. I started to teach others for one reason, because I know how painful it is to lose in the markets over and over again. And if you're watching this, you have probably been there too, jumping from a strategy to a strategy, hoping that the next one will work, falling for fake gurus who sell you indicators that promise 100% win rate, feeling completely lost, not knowing exactly what to do to make money. And then there's the emotional side of trading, cutting profits too early out of fear, over leveraging, you are trying to chase big wins, revenge trading, you're making impulsive decisions after a loss. Does that sound familiar? This is the reason why most traders fail. Instead of taking accountability, most traders will blame the markets or something else, but they do not realize that they are the problem. This will keep them in an endless cycle of losses. I am not saying that trading is hard just so I can flex on you because I am profitable and you're not. I am saying it because the numbers don't lie. There was actually a study that tracked nearly 20,000 day traders over 300 days, and they found out that 97% of them lost money. And guess what? Most of them gave up within their first 50 days. This proves that most traders are completely lost, and I was one of them. I spent 2 years in the markets losing, blowing account after account, buying different courses, and doing all the mistakes you can think of. But luckily, then I found the right guidance and everything changed. Now I've been profitable for over 2 years in these markets, making money consistently, and I average well over $1,000 a day. And guess what I learned? Making money in trading is not luck, it's a skill. Once I became consistently profitable, I started to mentor others. Then I realized something incredible. The exact results I had achieved, my students started to achieve too. This is one of my students, Mario. Before he joined my mentorship, he was blowing accounts left and right. He had no strategy, no risk management, and no clear path. But once he joined the program and I started to mentor him, he immediately started to do everything right. Now he has gotten multiple payouts from funded accounts and he continues to thrive. I mean, just look at this. He's already getting $900 days with his trading. This is one of my other students, Gozzetti. He literally joined 1 week ago. He said that before he joined, he blew like 6 accounts. With just 1 week inside the program, he's already seeing results. This is one of my students, Emilio. For the first time ever, he started to see results with his trading immediately after joining the mentorship. This is my student, Dred, who's now making $800 a day just by applying the things that I taught him inside the mentorship. And check this out. This is Ryan. He joined my mentorship, and within just 1 month inside there, he got a payout worth of $5,000. And again, check this out. Cristiano, one of my students inside the mentorship, who's now making over $500 a day with his trading. And all he needed to become profitable was the right guidance. This is my student, Finn. After 2 months inside the program, he said that I was the best thing that ever happened to him. He actually went from losing to profitable, completely transforming his approach to trading. And all this with just 2 months inside the mentorship. This would take forever for me to go through all of my students' results. But the actual point that I'm trying to bring here is that making money in trading, it is not luck. It is a skill. Because how are my students turning from a losing statistic to a winning statistic? Is it a coincidence? I don't think so. This again proves that making money in trading is a skill. And obviously, because I like to be statistical, out of all of my students, within just 3 months inside the mentorship, 85% of them are now consistently profitable and independent. And obviously, the rest 15% will catch up later. I will make sure of that. I mean, look man, my students, they were just regular people like you. They were struggling in the markets, blowing accounts, and doing dumb mistakes. They were actually, quite frankly, the 97% losing statistic. But now they're in the 3% winning statistic. They are free, profitable, making money consistently, and they have a skill that nobody can take from them. And all they needed was the right guidance, and they got that inside the mentorship. However, understand this one thing. They did not get lucky. They took action. They got the right guidance, and then they became financially free. And the best part is, you can do the same. These aren't just success stories. These are proofs of possibility. The world is yours. If they can do it, so can you. So what is holding you back? You have to first acknowledge that you have the power. You are in control. You actually can turn your trading from losing to winning. But obviously only if you're ready to stop guessing and start learning the right way. Elite Traders Lab is for the people who want real results, not just hype. No, just for fun, I wanted to ask my students, what is the best part about trading profitably? And guess what? Almost all of them said it's the freedom, time freedom. They trade only 30 to 60 minutes a day and enjoy life on your own terms. Location freedom. They trade anywhere in the world with a laptop or a phone with access to Wi-Fi. Financial freedom. No boss telling you what to do, no bullshit, just unlimited earning potential. But here's the harsh truth. 97% of the traders in the world never will achieve this. Why? Because most people unfortunately do not get access to the right guidance. And that is exactly why I created my mentorship, Elite Traders Lab. Here's exactly what you're gonna get inside Elite Traders Lab. A personalized one-on-one call with me. In the call, we are going to plan your step-by-step approach to your trading career and how you can later scale it up to over 6 figures in real money. And as a bonus, you get 24/7 private coaching access to me through chat, weekly live trading calls. Every single Tuesday, I will trade live in front of my students inside the Elite Live Trading Room. I call out every single trade that I take real time in front of my students. And obviously for the people who cannot make it to the calls, there will also be a signal chat for them. Elite Sunday strategy calls. I will teach you high-level trading strategies, risk management techniques, and psychology hacks that separate winners from losers. And I will teach you all of that inside the call. And of course, all of those calls will be recorded so you can study them afterwards. You also get access to Elite Traders University, my full trading course video library, covering everything you need to know to become a consistently profitable and independent trader. And obviously later, if you have any questions about the course, you can just ask me and I will answer you. You also get access to Elite Traders Lab Discord. Inside there, you can network with serious traders, share insights, share wins, and surround yourself with winners. You will receive one private invite to my real-life event where you will meet me and the other elite students in person. This event will be held in the future, but remember, you have one invite and it never expires until you use it. And as a bonus on top of all of this, you will get lifetime access to Moose Trading Premium. It has a value of over $1,000, but you're gonna get it for free to increase all the odds of you succeeding. So, hear me out. You have two choices right now. You keep losing money, you keep doing the same mistakes, stay in the 90% of traders who lose and keep being a statistic. Or you take action. You join the Elite Traders Lab to learn a proven system and finally start trading profitably. I'm here to guide you. If you are actually serious about changing your trading forever and gaining financial freedom, then fill out the application below to see if you qualify. But keep this one thing in mind. There are only a few spots available each month, and I only accept traders who are actually serious about becoming profitable. Once the spots are gone, they're gone for the month. So if you want to secure your place inside Elite Traders Lab, then fill out the application and we'll see if you qualify. Right, as usual, I will see you on the other side. Peace out.